ETH is rage pumping, and today, of course, when we're breaking that down, is this the moment we've been waiting on around Bitcoin and Ethereum finally disconnecting? You guys want to stick around for it. Before we get started, I do want to thank our sponsor, and that is Tangem, where you guys can get into self-custody, and it is one of the best ways to get into a secure hardware wallet. If you guys have not visited the Tangem website, jump over there right now. It does give you a full guidebook on how to get started in self-custody. It is seedless by design, and of course, one of the easiest wallets to use out there. So use our link. It's going to give you a little bit of an extra discount on top of what they're already providing to you. So check it out right now. You get it $40 and an extra 10% off. So that's the perfect time to get into, of course, self-custody. One thing I want to focus in on right now, ETH, of course, is it rage pumping? Because right now people are looking at this. Even though the Strait is closed, totally agree with that. War is kind of back on. CPI looks good, okay, I would say, agree to all of those things. And when you compare that to the chart, well, there's ETH versus Bitcoin. And it has been up and to the right. And it's actually in an area right now that may be in a green zone that could go into a breakout. So we're watching this one very closely. And we wanted to bring on a guest today to kind of break down some of the narratives behind what's happening with Ethereum. And of course, I want to bring on our guest, and that is Joseph Chalom, who's been with us before, the CEO of Sharplink. How are you?
Doing great, Paul. Happy to be back.
Yeah, so a lot happening here. First of all, when you look at the charts and what's happening with ETH and Bitcoin today, you kind of consider the macro headwinds, even some of the news on CPI coming in much lighter. Do you think ETH is actually breaking away from Bitcoin right now?
I think the last month or so, you've seen a rapid growth in the price of ETH from what was a multi-year low of about 1,500. Today, it's trading in the high 1,800s. Shockingly, I don't think it's actually macro. I think there's been a number of significant ecosystem announcements that over the last several weeks, the largest stewards of Ethereum have injected a bunch of confidence and stewardship and new organizations that are essentially reshaping the narrative. And I think it's as much a narrative than a macro. The other announcement that was really, really positive was Robinhood choosing the Ethereum ecosystem through Arbitrum. And this combination of ecosystem support, the new narrative, and another use case has been very, very bullish for the Ethereum ecosystem and also for the price of ETH.
All right, so a lot of things happening because, many people, we did a video last week actually to that point, is Robinhood causing a little bit of this pump because it's opening up some new narratives here. And we'll get into some of those. Some of what's been happening on Robinhood chain is we've seen a whole meme culture start to rise. But I think there's going to be some narratives that maybe have not played out just yet. I was looking at a tweet you guys put out, and it's in reference to your launch of ETH systems. This, of course, gets into a whole layer of partnerships. You've got, of course, Joe Lubin, the co-founder over there, and of course, you guys, Sharplink and Bitmine as well. First of all, what is this? And explain to me why this particular partnership.
Sure. This is the third of a number of recent announcements in the Ethereum ecosystem. And I want to be very direct. The Ethereum ecosystem lost its narrative and a bit of confidence as the Ethereum Foundation narrowed its scope and reduced the size of its group. Over the last month, there have been 3 spin-outs from the Ethereum Foundation: ETH Labs as an infrastructure builder, Ethereum Institutional, the go-to-market for Ethereum, and today a for-profit organization called ETH Systems that is focusing on institutional privacy and compliance. These are some of the densest talent organizations that are going on offense now, along with the private sector. And it's not a surprise that the backers of these 3 organizations are Tom Lee from Bitmine, Sharplink, and Joe Lubin, because the private owners in the DATs realize they have an aligned interest to support the ecosystem. And I think we see a rejuvenation of confidence and a turning around in the sentiment around ETH. The actual scoreboard has been great for Ethereum, leading in tokenization, leading in stablecoins, leading in DeFi by large margins. This is the sentiment and the confidence catching up to reality. And facts don't lie, even though the price has lagged. So you're seeing a concerted effort by the largest stewards and owners of ETH in the world to bring some clarity to what's coming in the future, which is this massive institutional adoption supercycle. And we're telling the story better than we have.
Well, I look at this and I kind of compare it to what's happened in the tech industry. Most of the time in the tech industry, you've got the titans of industry not working together. They are in factual working against each other in many cases, trying to steal talent, all that kind of thing. So why wouldn't these three entities just merge and just create one giant Ethereum machine and take it from there? Why not go that route? Because it seems like you're cooperating.
I don't think we need to merge to have aligned interest. Joe Lubin is a co-founder of Ethereum, a large holder of ETH, runs one of the largest Ethereum companies called Consensus. Tom Lee runs Bitmine with a very retail-oriented voice. I have a lot of respect for him. We have a more institutional approach, but I think there's nothing wrong with having co-opetition in an industry, but we're at a moment where we have more aligned interest than competition, and we're putting our dollars and ETH to that interest to support the ecosystem. And you're seeing, I don't know if it's a correlation or a causation, but since this concerted effort, you've seen the price of ETH rise from a low of 1,500, rally over 20%, not because it lacked the capabilities, it lacked the sentiment, and the sentiment has turned to be very, very bullish.
Yeah, well, it has turned very bullish, and I think one of the factors that might be leading that in is what's been happening on the Robinhood chain. This was an interesting analysis right here in terms of Robinhood's rent paid to Ethereum this is where they are right now in terms of factor of 4. If you look at the Arbitrum's rent paid. So the point is that there's a lot of movement here on this chain very early on is going to cause maybe the core architecture of Ethereum just to continue to grow and the price to go up. Is there anything that can slow this down?
Well, I think we're at a moment where the world's largest financial institutions, governments, central banks, top-tier GSIBs, and fintech companies are making a choice about their financial rails of the future. Arbitrum had a lot of choices across other layer 1 and layer 2s. They chose Arbitrum and they chose the Ethereum ecosystem because of its security and modularity. And I think what you're going to end up seeing is a number of these case studies by the largest financial institutions in the world. And I think we're at the bottom of the first inning of tokenization, stablecoins, and on-chain activity before you even get to an agentic revolution. So I think it's a proof point and it's a case study. And in a matter of a week, the volume you're seeing from Robinhood on the Arbitrum layer 2 Ethereum chain is massive, and we're just getting started. So I think it's a direction of travel. It's not the end game. It's the beginning of an adoption supercycle. So we're very bullish.
That's the application revenue I'm showing on screen right there. In a very short period of time, Robinhood flying up the charts here. Do you think that Robinhood will hit the same wall that Base did?
I think what we're going to end up seeing is that's a drop in the bucket. You're going to see Arbitrum support Robinhood on massive amounts of tokenized equities. You're going to see SpaceX trading. You're going to see NVIDIA in tokenized format. So I think as much as this is starting as a crypto platform and a crypto story, I think this is the beginning, not the end of the cycle. So I anticipate this growing very rapidly. And rather than hitting a wall, the target audience and the target market is any participant on Robinhood, not just those who are buying and selling Bitcoin. It's going to be tokenized assets and funds and commodities. So I think Robinhood is making a bet that these ecosystems are converging. And the target market is not trillions, it's tens, if not hundreds of trillions.
Interesting. Tens, if not hundreds of trillions. So, all right. Well, with that being the case, what would you say is maybe the next big retail chain that would jump into what is happening right now with Ethereum? Because this has been a big move with, I guess you could call Robinhood in essence a retail chain, but in reality, it is moving a little differently because of its tie to the financial industry. What about another maybe major corporation, retail, hospitality? Where do you see that?
I think the next thing you're going to see is most of the online brokerages who are competing with Robinhood, but may not be as tech aligned or crypto aligned, start building wallet infrastructure. So crypto on-chain wallet infrastructure side by side with their analog accounts. so that investors who are coming to them to say, I want to own Bitcoin or ETH or tokenized SpaceX or a tokenized BlackRock fund can continue to own that asset within a traditional brokerage firm. So I think Robinhood is starting the battle. And I think you're going to see people rinse and repeat because you have a younger generation who may not want to own mutual funds, who may not want to own private funds. They want to own things in tokenized format so they can trade it 24/7, so they can lend against it, borrow against it. So I think you're going to see people copying Robinhood because otherwise Robinhood is going to take not just the 20-year-old demographic, but the 30 and 40-year-olds around the globe.
For sure.
And I think this is going to be a global phenomenon. Traditional brokerage firms and banks building wallet infrastructure to appeal to a new generation of investors.
Do you think that TradFi was caught off guard by the success of where Robinhood was going? Because I think even Robinhood was maybe a little caught off guard here.
The traditional broker dealers and financial advisors have two challenges ahead of them. One is the neobanks and the fintech platforms that you see like a Robinhood in Hong Kong, Futu, in Korea, Toast, and KakaoPay. These are institutions that are appealing to a completely different generation who are inheriting trillions of dollars of wealth. That's one challenge. I think the second challenge is agentic. Do you need a financial advisor who's 56 years old, who can only manage 150 accounts? Or are the younger investors going to start using Claude and other capabilities to build portfolios, to rebalance portfolios, to move assets, to pay people? So I think the banking system either needs to open and engage, as well as asset management and financial advisory. Otherwise, they could be left out and intermediated by the new tech that actually makes it easier to manage your money than calling and visiting an advisor.
One other question I want to ask you, Joe. When you look at the biggest overhang for Bitcoin, and you kind of consider what Michael Saylor is up against right now, and where Quantum and Q-Day is for the core devs, how would you weigh that out right now in terms of the biggest overhang for Bitcoin right now?
I think the two biggest overhangs are, one, narrative. You know, I'm a huge proponent of Bitcoin and people owning Bitcoin in their portfolios. This is not an ETH versus Bitcoin story. And when I was at BlackRock, we launched the largest Bitcoin ETF in history called IBIT because we had institutions who wanted to own it. The narrative was that it was digital gold. It was a hedge against inflation. It was a hedge against geopolitical risk. So I think the biggest challenge is it hasn't been behaving that way over the last year or so. It's been trading as a risk-on asset. And when investors want other risk-on assets that might have higher returns like NVIDIA, SK Hynix, Samsung, SpaceX, you know, Bitcoin is a little bit out of favor. The second issue, as you mentioned, is quantum. You know, Ethereum and other platforms are building very quickly to quantum proof themselves before 2028, 29, or whenever D-Day is. The Bitcoin ecosystem is going to be very, very challenged, especially the fact that there are very large accounts that have not been opened or touched. It's very unclear who the owners are. And if the Bitcoin ecosystem needs to fork and change their code, are they going to leave behind some of the largest portfolios and holders of Bitcoin? So I think it's narrative and getting back to this being digital gold, and you want to own it because the world is debasing their currencies, and you need to make sure it's quantum proofed. Otherwise, I think you have a fundamental risk to Bitcoin and the price movement. And I think it's been lagging because it lost that narrative.
Joe, do you think that that has come home to realization within Wall Street, traditional finance, of seeing what's happening right now with Bitcoin, seeing the drama with what's going on with Stretch and MicroStrategy, and understanding the real threat, you know, from quantum and Bitcoin's kind of inner turmoil that they're dealing with right now? Have they realized this at Wall Street?
Well, I think one of the reasons why Bitcoin has declined in price is that Michael Saylor and Strategy went from being a massive net buyer of Bitcoin to, at this point, a bit of a seller. And it's part of the Bitcoin conundrum, which is it's a great asset to own if you believe governments are going to debase currencies. That said, as a treasury asset, it's quite challenging because if you want to drive returns, outsized returns, you have to financialize your stock. And you're seeing Michael Saylor in a bit of a pickle on the one hand, needing to satisfy debt repayment on converts, dividend payments on preferred, and the only way he can do that is raising new capital or selling Bitcoin. So I think you have selling pressure, not an incremental buyer of Bitcoin. I think that will change over time, especially if the AI narrative on Wall Street slows down. You'll see people rotate back into Bitcoin and other crypto assets.
Well, I mean, I don't know if it's going to slow down. If you look at the AI mining boom, which is another effect that it has, it may reaffirm the whole concept of what's going on with Ethereum in terms of proof of stake. Because this is a typical miner that's out there getting price bumps because of just contracted AI data center deals that they're doing. And this is one of many. We talked about TeraWulf the other day, obviously this being HUD 8. I mean, do you think institutions are understanding that there is a bit of a dynamic shift right now in the core center of where Bitcoin is actually curated?
Yeah, if you're a Bitcoin miner and you have large data center rigs or compute capability, every day you have a logical choice. Do I point those machines at Bitcoin mining? And at this price, it's pretty underwater. Or do I go with the AI narrative and become a hyperscaler? The best example of someone who's done that really well is Galaxy Digital and Mike Novogratz. They were one of the largest Bitcoin miners out there. And instead, they're building West Texas data centers as a new strategy. So I think that is a challenge to Bitcoin. And that is a decision people make every day. But once you pivot your strategy away from mining and you're making multi-year commitments to hyperscaling data centers, you're selling your capacity, it's very hard to switch back to Bitcoin mining.
So with what you just said, wouldn't proof of stake, wouldn't this kind of be the time for it? Because everybody's going to realize that this is a completely different model of how to do this.
Yeah, I think the reason why Ethereum is more attractive at the moment is Bitcoin does a great job store of value. It's cryptographic, it's decentralized, but it's not programmable. You can own Bitcoin, you can move it. Ethereum is ending up to become the new financial infrastructure, not just of stable coins and crypto and tokenized assets. The world's largest financial institutions, BlackRock, Franklin Templeton, JP Morgan, Robinhood, are building the next generation of tokenized deposits, funds, ETFs, and retail platforms on a programmable, decentralized ecosystem.
Right.
So Ethereum is more in demand. And the most important thing is why, is because you can have large portions of the financial ecosystem trade 24/7 with instant settlement and reduce all the risks you see in T+1, T+2 trading in the US and Asia. So you have to worry less about counterparty risk and a war being launched on a Friday night and you being locked in. So it gives a much more nimble, programmable experience to investors. And that Ethereum is becoming that global settlement layer in a way that Bitcoin can't as just a simple store of value.
Okay, all right. Well, taking what you just said, Ethereum becoming a global settlement layer versus where Bitcoin is going, this came in from Saylor and Fong Lei. We, of course, had Fong on the show before, and they basically it was some research for them, the Bitcoin Banking Adoption Index. I want to show this to you guys because this surprised even me in terms of the list right there. You've got Fidelity, BNY, Goldman, et cetera. And they've got a whole list of what they're dealing with, both on traded custody, products, margin, et cetera. But they're claiming, I don't know if this is accurate, but claiming that there are 32% in terms of an adoption index. How does ETH compare? When you look at the same kind of names right there, that's a pretty, star-studded list of top banking industry right there in the US. How would ETH compare?
So I haven't seen this report, but I'm assuming this exposure and adoption is largely coming from the wave of ETFs that were launched in January of 2024, where the banks themselves may not own this Bitcoin, but it could be that they're custodying it for customers. If you're a large wealth manager, it's in your portfolio. So that is an interest from their end clients to own it. I don't think most of this is in the banking balance sheet. Ethereum, people are building on it. The world's largest financial institutions are adopting it. And they then have to own ETH to secure their transactions themselves. So I think it's a difference of exposure versus use. And I think in Ethereum, you're going to see a lot more adoption and use of the platform rather than just holding it on behalf of your customers. That would be my take, having not seen this report.
So, Joseph, you talked a little bit about fintechs and the idea of what we're going to see in terms of adoption. A lot of this new market out there is dealing with variable and stable yields. One of them, of course, is Aave's new stable vaults infrastructure. This is now launching. And now you're going to see almost any fintech out there that'd be able to offer this kind of on-chain yield to their users. My question is this: do you think fintech users would choose stable versus variable yields if they're similar to each other? I mean, I know where I'd go, but what do you think in terms of users?
I'll be a little bit controversial. Most depositors at banks and most people who have idle balances, they're not even getting interest or market rates. So the first step is to give them real world yield, even if it's just 3.5%, money market type rates by owning a stable coin or owning a tokenized yield vehicle. There are hundreds of billions of dollars of idle assets at the largest banks in the world who are earning no interest. So I'm going to be a little bit controversial. The first step is giving them yield and giving it to them where they want to have it, which is in an on-chain portfolio or an on-chain wallet. And hopefully the largest institutions will start offering that. You saw Charles Schwab offer wallet infrastructure, Fidelity, and not just Robinhood. The second question is, what other types of yields can you get on-chain? Well, a lot of these protocols like Aave and Morpho are not just earning yields, they're actually offering you credit type exposures.
Exactly.
They're offering you an ability to take not just your Bitcoin and lend it, but if you own tokenized Tesla, NVIDIA, or SpaceX, for the first time a retail investor can lend it, secure that, and get a return. Large institutions and Wall Streets have been doing that for generations. Take an asset, lend it with a counterparty, 3 days later, get it back. Now retail is going to be able to do it. And with agentic, their agents are going to be able to do that autonomously. So you almost have a CFO in your wallet for a retail investor. If you have an on-chain wallet, you have an access to yield, it can rebalance your portfolio, and it can get you credit exposure and returns that you can't have if you're just parking an asset in a traditional institution. So I'm very bullish that this will actually be amazing for retail investors. This may be a generational step up of capabilities that to date was only reserved for Wall Street and Wall Street treasurers.
Well, and to your point, because this is something that Saylor has been trying to do with Stretch, and that is legitimize, the idea of credit, private credit, and also the idea of stable, which of course did not turn out so well for Stretch. So it's probably going to put a little bit of pressure. But back to my original question, I think at least when you look at fintech operations out there, whether it's Aave, Morpho, and several others that are going to be offering this, and especially if this goes into on-chain yield for almost any fintech out there, wouldn't people lock in on these stable yields versus these variables, which is what we've seen happen with Stretch, and choose that over?
I think it's two different investments. One is someone trying to seek a 3.5% stable return. Those are no-brainers compared to where you're parking your cash and assets today. I think the second is an investor trying to take a credit risk, trying to get an 11, 12% return, and hoping that the collateral and Michael Saylor have enough confidence that you've got great collateral, you got great security, and now you're able to get 11, 12% returns. I think it's two different investment theses, but I think they're both available. And these are revolutions compared to what was available to a retail investor even just 2 to 3 years ago.
Yeah, for sure. Let me ask you this. You have seen all of these fintechs. They've launched wallets. Now you see DeFi and free wallets out there. MetaMask, a good example of this right here. They have their money accounts live. You can get 6% APY right now. There's variations on this as well. Do you think that the next generation of retail customers who are now getting access to all these new tools, that they would choose a $5 subscription? I mean, right now I'm paying $5 a month, I think, for Robinhood Gold. That's $60 a year versus a wallet product that I get for free, and I get very similar services on it. How do you think that's going to land out for companies like Robinhood and a lot of these other neobanks and fintechs?
I think $5 a month is a very small subscription fee. I think what's more important is people are going to be doing more of their daily financial lives, social lives, and prediction lives in these infrastructures. Think about it.
Yeah.
You can have it almost as a bank on your phone. You can get yield. You can buy crypto assets. Soon you're going to be able to buy tokenized stocks or wrapped ETFs or SpaceX. Then you're going to be able to borrow and lend it. You're going to be able to get credit-like returns and take credit risk. You're going to be able to participate in prediction markets, which is just another way of voting your sentiment. So I think you're going to see people like they spend a ton of time in the meta ecosystem, with Facebook
Yeah.
and
Yeah.
WhatsApp and Instagram. These are new financial centers for people. And I think the banks are going to have to really step up their game because you have a
In a big way.
generation who's inheriting the greatest wealth transfer in history, over $100 trillion in a decade and a half. These people trust code, their phones, more than they trust traditional institutions. So I think this is going to
Yeah.
be a center of financial activity more than just a yield play or a deposit play or a crypto play. And when most equities in the world become tokenized, they're going to sit in wallet infrastructure. So I think it's just a new primitive for how people are going to manage their daily lives. When you layer in agentic, it's going to be the greatest consumer experience they've seen, as long as the guardrails are correct.
Yeah. Yeah. Speaking of that, okay, let's look at Clarity, and let's go one direction. Clarity Act fails. We're assuming that. Not saying it will, guys, but let's say it does. You look at the performance of the recent performance of what's happened on Robinhood chain, which has gone almost completely retail oriented. Why wouldn't Bitmine and Sharplink type entities look at retail versus institutional if in fact we get a failure at Clarity?
So first of all, I'm confident it will happen. It's not clear it'll happen before the August recess, but I think there's enough impetus to get it done this year. If it doesn't happen, you have Chairman Atkins at the SEC and Chairman Selig at the CFTC. While I'm not saying they're acting in unison because they're independent
Yeah.
regulators, they have a plan to rule make most of this. I think if the Clarity Act does not pass, the biggest losers are going to be the DeFi protocols who don't have a clear operating model on whether they're a software company or a regulated financial institution.
I
But
see.
stable coins are in good place. Tokenization is in a very good place. So I'm really not concerned about that. Now, Sharplink, our goal is to give our investors access to this large Ethereum opportunity we're talking about, stake our ETH, give yield to our investors. So I don't think the digital asset treasury companies are highly affected by Clarity. The more important thing is that you have clear rules of the road for DeFi participants, because DeFi is going to be the new transaction layer for a tokenized economy. So I think
Yeah,
stable
for sure.
coins will be fine. Tokenized assets are going to be fine. DeFi is going to be challenged without clear regulatory guidance.
All right. So with that statement, you look at something like a Uniswap. I'm just looking at this right now. Uniswap is literally bumping into Circle right now when you look at fees as well as the overall market cap, as well as just the activity that's happening right now. When I'm looking at this chart, you've got Uniswap moving up quickly. Do you think it could ever get into a position where Uniswap could actually flip Circle?
So I think they're two different things. Uniswap is, I think, one of the most successful DeFi platforms in history. They have an ability to create a automated market maker to trade anything for anything on chain. To date, probably 80% of it has been Bitcoin, ETH, Solana against Tether and USDC from Circle. I think if tokenized assets end up coming on their platform, they will become one of the most important venues for exchange of value and liquidity. I think the selling of Circle and this narrative that Circle would be less successful because of a launch of a new stablecoin called OUSD, I think that is overblown. Circle and its USDC are largely the most used stablecoin for regulated type activities, buying and selling, moving assets. I think Tether is still more of an offshore, unregulated entity. So I'm actually bullish on Circle. especially in the age of agentic finance, where these agents trading with agents need to make micro payments. They're going to make it in stablecoins, and that's going to happen on Tether and USDC. Jeremy Allaire, the CEO, put out a great primer on agentic finance. I would actually encourage people to watch it. It came out earlier this week. So I actually think it's not Uniswap versus Circle. It's really a question of will they have the regulatory clarity to do what they need to do? And when assets become tokenized, it's going to become a righteous cycle for both of them.
Yeah, for sure. Well, you look at Robinhood and just their 24-hour DEX volume. This is insane, these kind of numbers. But it just shows you the appetite that we're looking at right now. And remember, Robinhood is doing all of this on GUSD. So I'm kind of curious, do you think we would see that stablecoin really start to rise up the ranks? Could it be one of the top 2 or 3?
I think so. I think, stable coins on the venues where people are transacting, that's in Hype, it's in Uniswap, it's in Robinhood. The real question is, are they going to be open infrastructure and architecture and allow any stablecoin to operate? I believe they will. Or will they do things to give preference to their own corporate stablecoins? And I think we're in a very important moment in the stablecoin adoption space. Is this going to go into a world of oligopoly where there's 3 of them, they dominate it like every other tech trend we've ever seen? Or is every corporate going to have their own stablecoin with preferred access and yield if you're working in their app? And I think that battle has not been decided. That said, the top 2 stablecoins are probably 90% of all transaction volume. History is still going to be written as to whether this is going to become something that is distributed, or is it going to be highly concentrated like every other tech trend we've seen over the last 2 decades?
Yeah, and just for clarity, I'm talking about USDG with Robinhood in terms of the stablecoin side of things.
Yeah.
A lot of activity around the idea of equity, okay? And this is getting larger and larger. The demand on it is getting more integrated. We're going to see more projects coming out on this. This, of course, is another one that's starting to launch, which is a project called CAS. And we've talked about this one before, but now we're starting to see equity tokens starting to show up in very interesting places. And even now, where we may see native tokens come out with an equity architecture within it, do you think equity season has begun, especially with everything that's happening with Uniswap, most likely maybe down the road with Hyperliquid, et cetera? How do you see this playing out?
Well, there's 2 equity stories. One is in the token space, and I think it's fair to say that we haven't had a token launch that's been highly successful in the last several years. The vast majority of token launches are down 95+% because there's no alignment of interest between the labs or company that owns the equity and the token holders. And the distributed governance has been really challenging. I think you're going to go back to the standard VC model where someone raises capital, it's in the form of equity, and they live or die based on the revenue they produce. Because I think we've seen zombie protocols who raised massive amounts of tokens, but actually don't have real business models, but they're surviving nonetheless. Paul, the second story, which we haven't talked about, is tokenization of the world's equity markets. That's a different equity story. I actually think you're going to start seeing most public companies tokenized over the next couple of years, and you'll have a better experience owning the tokenized version because you can trade it 24/7 on chain, on a centralized exchange, or soon on NASDAQ or New York Stock Exchange. So when there's a war declared on a Friday night and you want to express your view that you want to sell a stock, you don't have to wait till Monday. So I think the token DeFi story is really challenged, and I think you're going to go back to the VC model. Tokenized equities in the hands of most investors, to me, is the bigger story. There's $160 trillion of public equities that are waiting to be tokenized.
Well, interesting analysis there. We're paying very close attention to this as we watch many of these projects kind of going this direction. So we'll see how that lands out. Joseph, it has been great having you on the show today. Thank you so much for coming in. We appreciate it.
Thank you, Paul, and I look forward to being back soon.
If you like this video, hit like and subscribe, drop a comment down below, and also join our free private member group. The link is in the description.